And VP Singh of Pramerica Mutual Fund are our guests at this point. Gentlemen, morning to both of you. Mr. Singh, I want to start off with you. It's been a couple of days of consolidation, and we've seen some trimming of positions both by domestic institutions as well as FIIs. Would you use this as an opportunity to put more money into the market at this juncture?
Yeah, hi, good morning. Yeah, surely this is now the time to actually start putting not only more money into the market, actually switch the asset allocation from the debt to the equity. In our opinion, which we have been mentioning since last 3 to 4 months, that now we are into long-term bull market, but that market now gets more legs, and one should be more convinced. Every consolidation or a correction actually should be used as a buying opportunity.
But what are you buying, Mr. Singh? Are you continuing to buy the public sector units, Coal India or BHEL, that kind of companies? Or are you preferring the public sector oil companies? Are you preferring public sector banks? Are you preferring public sector at all?
See, public sector was something which actually became a flavor of the month because of the election results which came out. Let's accept that we are buying this market because the underlying economy is likely to do well. And the economy will do well both because of the cyclical factor which is coming in its favor and also the effort on the part of the governments. So therefore, practically all the sectors in the economy are now becoming attractive, except for the FMCG, which in our opinion is now going to get into the serious correction phase. So if you look into the rest of the economy, the sectors who are not run are the one where one need to focus on, because we believe that the economy will now start trading at a much higher PE, the earning growth will actually catch up with it, and so therefore that will put. So now as far as the PSUs are concerned, they are attractive, but the recent rally actually makes us book little bit of profit from there and move to the others who actually not participated. So we are buying everything, right from IT, pharma to all the old economy stocks, because our opinion is it's the PE of the market that itself is going to go up.
And to what? What do you expect valuations to go up to? Because we've seen a goodish bit of jump, isn't it? From what, 14.5 to 15.5 plus already in terms of valuations?
Yes, that's what you see right now. But you see, when the onset of the bull market takes place, the earnings actually catch up later on. First the PE comes and the market starts delivering. In our opinion, the index earnings will actually start moving up in the range of around 30 to 35%, 12 months down the line. So it will take at least 4 quarters when you start getting into that kind of earning growth range. So therefore, what appears to be a little bit costly number in terms of the PE at this point in time will start appearing very cheap if you get 6 months down the line and start valuing the same stocks. If you go back to 2003, 4 and 5, that year, you notice that every time all the analysts were analyzing the Indian market, they always used to believe that it's a costly market. But that's the mistake which happens in every bull market which starts, that you feel that it's costly, but it is always cheaper.
Mr. Singh, we were just speaking with an analyst a while back on the possibility of the Modi government breaking up Coal India. What are your thoughts on that? And if that actually takes place, then how would you approach a stock like Coal India?
Well, I would not like to comment on an individual stock, but I will definitely like to say, if you look into this particular government and look at the kind of signals which are coming through their manifesto, most of the things which they are discussing, this government actually believes in working in details, and rather than actually going ahead and doing the big bang announcements. So details actually brings the EPS growth in the corporates, the value creation which takes place in the industry, and that's what actually making everybody excited about most of these companies, and so are we. Because what you will notice that it's the efficiency gains, making each and every small unit actually go to their best and try to perform. That's the mantra on which this government is likely to focus on, and which is a fantastic news as far as the market is concerned.
Mr. Singh, what are you advising your investors to buy at this juncture? Or rather, what are the stocks what are the sectors that one should be looking at this point?
Well, we were quite well positioned in the old economy, that is the public sectors, the banks, the capital goods, etc. But they are given a good amount of run, and there will be temporary consolidation which we are expecting. So, but at the same time, there are valuation corrections which we are noticing in the IT and pharma at this point in time. So we have marginally started allocating our assets from the sectors who have performed in the recent times, because in our opinion, the next 2 to 3 months, the market and some of these sectors are going to go through a little bit of consolidation, because they will look for signals from what the new government, respective ministries are going to do, what kind of policies emergence takes place, because hopes are now something which is being met. Now the performance, that's where people will have to get into. So we are shifting and balancing our portfolio between so-called defensive as well as the aggressive stocks. The only sector which we are not buying at this point in time is FMCG.
Okay. Since you indicate so many sectors, Mr. Singh, can you help us in this fashion? If you had 100 rupees, what would be the percentage investment in the various sectors? How much would go to, say, banks? How much would go to PSUs, if you can make a category like that, oil and gas, IT, pharma?
Well, if you go by the index basis, Nifty, you will notice that the index has close to about 25% in the banks, and so we will continue to have little bit of overweight position over there. You look into the IT and pharmaceutical sector, put together, they have roughly about 25%, so we will continue to have the equal weight position over there. Capital goods and other sectors, if you look into, they put together have around 15%, and so we have an overweight position over there. So these are some of the 3 major segments of the market at this point in time. Now, all these overweights are funded by the underweights on the FMCG side.
Mr. Singh, the flavor of the week has been mid-cap stocks. Is there any other sector you would look at? For instance, would you buy, say, the gold stocks, or would you buy the railway stocks? Precious little research is available in this, but will you go this far?
Yes, of course, because mid-caps is one sector where the ownership of FII is very low, and that's why you'll find that the valuation gap exists. Now, with the kind of growth which we are seeing in future, the revival which will take place because of the domestic economy and not driven by what's going to happen in the global markets, you will find that it will percolate down to the smaller stocks as well. So that means there is a good opportunity for the mid-caps, and the sectors which you pointed out, whether it is railways, whether it's related to port, whether related to power, whether related to the construction, because if you look into manifesto, the kind of statements which are being there, that the government is planning to build 100-odd cities. So various other things which are needed for that, these mid-cap companies are going to play significant role, and so therefore we are consciously focusing on them and picking up stocks in all these sectors, and they may not perform immediately because it's not that the orders are going to be given tomorrow, but definitely there is a roadmap which is being now seems to be building up, and these stocks over a medium to long term are going to deliver fantastic returns.
All right, Mr. Singh, we'll let you go at that. Thank you very much for joining us. We are just about